September 6th, 2023. When you get a gap down, I think the most important thing is to pay attention to if we're able to get back to the prior day's low or if the gap stays open. It's the same thing if you get a gap up, pay attention to the prior day's high, but in this case, there was a gap down. So I think the most important thing is to pay attention to if bulls are able to drive the market to this low. The reason is if they are, it makes you assume that the market is going to be in a trading range. And if they're not able to, it makes it more likely the market's going to be in a trend for the day. And, obviously if they're not able to close this gap, it's going to be a bear trend. We also got an open gap here. You can see traders who bought below the 3 low and bought more lower were not able to get out at break even. And so when you get a couple of open gaps early in the day, you have to be thinking it's a possible bear trend day. There was also an open body gap here with the 8 open and the 14 close. The reason body gaps are important is because a lot of institutions use line charts. And so if this was a line chart, these tails don't exist. It's just closes. So those line charts only care about closes. So when you have multiple open gaps early in the day and the market's trending down, you have to be thinking bear trend. Additionally, you can see that bar 6 and 7, when you get a giant bar like bar 7, it doesn't look as giant now, but during the day, this is a huge bear surprise. Whenever you get like a big bar like 7 after, relatively small range, you should, and especially if it's early in the day, you should immediately be looking for a measured move down a bit. And that should be, you're looking for a sell somewhere to get down to here, because there's about a 60% chance that if you sell below 7, you're going to get a measured move down of 6 and 7. And that's pretty much exactly where we got to on 21 before we got that bounce. It wasn't much of a bounce, but it went sideways for a little bit. But it was more important to, I think, keep in mind that we're probably going to find buyers when we get to that measured move. And it's far more important to keep in mind that these open gaps should be, blinking warning signs for you that this might be a bear trend day. Bar 1, big bear bar closing near its low. Good for the bears because it decreases the chances that we're going to get back to yesterday's low. Follow through on bar 2, but the follow through is kind of disappointing. You can see bar 1 didn't close quite on its low. And so if you're going to sell below bar 1, you want another big giant bear bar. You want a bar like bar 7 to go through and just sweep you into the trade. And bar 2 just doesn't do that. And so when you get, if you had sold below bar 1 and you see bar 2, you're probably just going to buy back your shorts below 2 and take a small profit, maybe a point or so. And that's, a big part of what causes bar 3, 940. But you have to keep in mind that when you get bar 3, that traders who sell above 2 and sell more higher are probably going to be able to get out at break even because, again, at this point in the day, trading range is most likely. And so that if you're selling up here, you're probably going to get back to this high. You can see on bar 4, it ended up being a big double top, but traders, we got back to the 2 high and traders bought back their shorts. Additionally, anyone who bought pretty much at any point during 3, disappointed in 4 and uses, I don't know why I'm using my cursor over those. I'll stop doing that. Uses bar 5 to get out at around break even because bar 5 essentially, it trades up towards the top of bar 3 where there are bulls who bought waiting to get out around break even because they did not get the follow through they wanted on 4. Then you get bar 6. Bar 6 is an inside pattern. So bar 5 and 6 are inside of bar 4. More accurately, bar 5 is inside of bar 4 and bar 6 is inside of bar 5. And so when you get an II early in the day, it's going to be a reasonable swing trade. And, I don't know who was watching during bar 7, but bar 7 got below bar 3 and broke out of that low within, 6 seconds of the bar forming. So it was really challenging to get in during that bar. And you ended up getting a giant bear bar closing near its low on bar 7. And it is important to note that during bar 7 did pull back to around this low, but it ends up closing down here and the closes are more important. Why is it important that it pulled back to this low? Because traders who bought that low and bought more lower had a very, very brief window to get out of break even, but it's still, or break even on their first entry, profit on their second, but it's still really insanely hard to do. So it's unlikely that a lot of bulls took that chance. So most likely still a lot of trap traders when you get the big close on 7. But this inside pattern is important because, when you get those on the open, they're often, we got to swing, I don't think I'm going to be able to find it. I'll see. I think it was too far. I might have examples. I on the open. Okay, here it is. Yeah, great. Okay, so we got an inside pattern on the open. This was August 23rd, 2023. And you can see we got bull bar, but big, selling and then inside, and that led to a trend day. And so when you get inside patterns on the open, They're reasonable swing trades. And when you get the big follow through on 7, you don't really know what the rest of the day is going to look like. So it's probably okay to just hold on the close of 7 and hope you get a couple more legs down. Bar 8, pullback. It's kind of reasonable to think there's going to be some profit taking after a giant bear bar like 7. 6 and 7 is probably enough to get a second leg, but we might pull back a little bit first. But the important price to pay attention to is the 3 low. Are we able to get to the 3 low? Because, like I said, that's where bulls will buy, and they want to buy more lower and get out. But if they're not able to, they'll be trapped. And so it'll drive the market down further. So whenever you get a big breakout, you need to pay attention to the breakout point, because that's the most, that's the most critical thing to understand in the stock market, pretty much, at least in my opinion. 9, you can see anyone who sold the close of 7 or sold below 7 is disappointed in 8 and is getting out around break even during 9. And then you get bar 10. So basically any bears buying back shorts, around that low, and bears are going to keep buying back shorts, and that's going to cost 10. Why are they still buying back shorts? Because they see that other bears are buying back shorts, and so they're disappointed in 9 as well, and they'll buy back their shorts, causing 10. 10 is a double bottom, but it's a deceptive double bottom. I used to take this kind of trade a lot. I was thinking like, well, it's a double bottom below the moving average, so it's a reasonable buy because it's a double bottom below the moving average. I mean, you're paying a below average price for a quote unquote reasonable bull setup was my thought process. But the reality is you're gonna have a lot of bears selling here trying to defend this low. You also know we're probably at least getting back to the 9 high. So there's probably more sellers than buyers above 10. So I don't think it's all that great of a trade. You're also buying a breakout of a tight trading range with 8 and 9. And that's another really big problem, is buying in tight trading ranges. So 11, big follow through for the bears and breakout to a new low, follow through on 12. But you can see we basically got back to the 10 low. And think about it, if you bought below 10, how disappointed are you in 11? If you bought below 10, you wanted to start getting bought back up, but you literally got a giant bear bar closing near its low. That's about as bad as it gets if you bought below 10. And so on 12, you just tried to get out of break even if you could. They got close. So some bulls took a small loss and just got out. Or they bought, maybe they bought the breakout and they got out around break even somewhere on 12. 13, you can look at it as a wedge, I guess. 1 sell climax, 2 sell climaxes, 3 sell climaxes to 13. But at this point, you have an open gap and you have this open gap. So I would not even be thinking about buying. You're either short or you're flat, I think, is pretty much your choices until market clearly flips to always in long. 14, bad follow through for the bears, which is not surprising. You would expect, bad follow for the bulls, which is not surprising. Again, you're expecting sellers above this because this is good enough for a second leg. 15, low 1 short. It's hard to get short during these days. So the easiest thing you can do is whenever you see a pullback. So let's say, you see the open gap, right? You see this open gap, you see this open gap. You start thinking, well, maybe it's a bear trend day. Okay. Well, you can sell the breakout below 8. You don't sell the breakout below 8. You wait for maybe one more open gap, right? You want to see the body gap. And so you get the body gap right here. And then maybe you're selling, maybe you sell the breakout below 12. Maybe you sell the breakout below 12 during 16. So those are all credible things to do. And then you get 17, bad follow through for the bears, selling the new low, but it never triggers. And so you get 18. And essentially, if it triggers, some bears might exit, and bears know that, and bears will sell this close trying not to let it trigger. And that's what happens over here too as well, and over here, but we'll get to that in a minute. Bad follow through for 18. It's a tight bear channel. And the good way to be able to tell, like I said, the gaps are an easy way to, look at if this might go on all day. But, these types of bear trend days don't offer a lot of good entries. That's why just selling breakouts, breakouts below anything, sell any breakout below anything, sell any bear close. You can even sell bull closes, but it's smarter to just sell bear closes and breakouts. Sorry. 20 follow through, more follow through on 21. It's just a tight bear channel, and 22 starts what will probably be a pullback. It's still always in short. It's been always in short the whole time. Bad follow through 23, probably sellers above. You can see there are sellers above 24, inside bar 25. Sellers above 25 probably. Just basically the moving average is going to be the target here. 26, 27, bull bars, but not all that good. Could just be leg 1, pullback leg 2, and then 28 a potential sell. But the problem with 28 is you haven't touched the moving average yet. At this point in the day, you can see the moving average is getting more flat. And so you have to keep in mind that we're probably going to touch the moving average. And something else I wanted to note is that you can see how, the bear trend line here is pretty steep, right? And so then we get a pullback and we get this bear trend line, which is somewhat steep, but it's not quite as steep as this one. And then suddenly the bear trend line gets way steeper. Why is the trend line getting steeper? If you're deep in a bear trend and the trend line starts getting steeper, it's probably parabolic, and it's better to look to get out, as low as possible or just above the next bull bar, like 44. So, again, as big as the red flag should be going off in your head about its potential trend day with all these open gaps, it should also be going off in your head. This is a potential sell climax, in the end of the trend when the trend line gets steeper and more parabolic. Bad follow through 29, basically trying to test the 27 close. And only bought the 27 close, disappointed 28, trying to get out 29. They fail. You get 30. Potentially, it triggers the sell below 28, but I don't think the sell is all that great. I'd rather, wait to sell lower if we get strong breakout bars, or just, look to sell at the moving average. So sell higher or lower, basically. But I just feel like you might be selling in the middle of a trading range, and it's not the best idea. But it's still okay to be short. So, I guess it is still sell the market. So I just completely contradicted myself there. But, I guess here's a better way to phrase what I'm trying to say is that it's still sideways price action. So you could get a bounce, but you have to keep in mind if you're trading the always in position, which a lot of swing traders and newer traders do, then it's okay to just stay short. 31, it's a high to buy, but it's not very good. 32, outside down. Trades below 22, but probably gonna, maybe find some buyers. Something you can note is that basically if you buy below 21, when it triggers, you should be able to make money. And you can see we end up getting essentially a wedge attempt at 33, but it's not that good. And then you get 34, 35. I think 35 is not a legit good buy, but it's definitely a spot where bulls or bears who are short should be exiting above bar 35 if they're still short. And you notice that it never triggered. Why didn't it trigger? Because bears know that other bears are going to exit above 35 if it triggers. So they aggressively sell at the market and sell, basically every tick up to this high, trying not to let it trigger. And what some traders will do, it's true that some traders are adding to their position here. They're already net short something and they're adding to it, trying to not to let it trigger. But some traders will just see this and they'll sell the market immediately with maybe 2 ticks of risk and hope to get, something like this. And then they make 6 points. And so while this type of trade doesn't work very often, occasionally when it does normally offset the risk. But this isn't worth doing, but it's just something to keep in mind when you see a bar like this and that traders, bears are going to exit above here and you see traders sell the market. Same thing with 37. You think we might have to get back to the 35 low. It's a potential, bear trap, failed bear breakout below, potential trading range. See if 37 can trigger. You see bears immediately sell the market. 37 can't trigger. You get 38. 38's an inside bar, low one short, follow through 39, 40. But you can see this is getting pretty parabolic and we're starting to get a stronger looking bear trend, but we're really deep in the bear trend. So when the bear trend starts looking stronger, far into the trend, that's again another sign to just be wary. But still always in short, still sell the close, sell the market. Follow through on 40, not that great. And 41, also not that great. You want bigger, stronger bear trend bars closing near their lows, obviously. 42, first reversal attempt, but probably not that good. And then essentially buyers below 42, 43, and then double bottom 44. I would get out above 44. And the reason being that this is not only a double bottom, but it's also 44 on its own is strong enough for a second leg. If you can't see to get out above 44, that's fine. Just get out above 45. 45 is clearly a strong pair of bull bars closing near their highs. You should get out above 44, but you don't absolutely have to. But you definitely have to get out above 45. You can see that when you get, 44, 45, show me another time today where we've had a pair of bull bars closing near their highs consecutive. Show me another time. It hasn't happened. And so when that happens, we're probably at least getting to the moving average. And as a fact now that 44 and 45 is strong enough to probably get a second leg. So traders exit above, causing 46. And you can see since there's basically 45 was the point where everyone agreed that bears need to get out of shorts and bulls will start to buy. You can see 48, 47, bears will sell the moving average with limit order. And we're getting back to that 35 low. So you can see, traders who bought below 35 did end up making money, which means that the trading range started at 35. So this is just a trading range. But my overall, I got a little sidetracked there. My point being that the 48 low essentially tests the 45 close. And so traders who bought, here, this is essentially a breakout test on 47 and 48. 49, bull bar closing near its high and follow through on 50, but sellers above the tight trading range on 51. This is okay. Generally when you get to the moving average on a trend day, you should be looking for a gap bar sell, like some sort of wedge top set up above the moving average that you can sell for a swing. But 44, 45, and 46 are so exceptionally strong that I don't really want to take any sells. I'm more in looking to buy mode. And one of the ways to look to buy is look for that wedge, the bear wedge, and then once it fails, look to buy the breakout above it, which is what happened on 1661. But I'll get there in a second. 51, follow through for the Bears. Bad follow through for the Bulls. I'm very tired, so that's why I'm stumbling a lot today. So 51, bad follow through for the Bulls. Bears tried to get a double top, but failed. 52, big bear bull bar, but you know that we're probably going to get back to the doji's high, which you do in 53. 54 and 55, Bears essentially trying to set up a 3 push pattern, but it's extremely sideways. I wouldn't want to take anything here. 56, bull bar, but not that good. 57, just tight trading range. That's why it's not that great. I'd rather wait. But the important point is we essentially had a tight trading range here, and we tried to get a wedge top at 59, and it failed, and we broke out above it on 60. So there's about a 50-50 chance that we're going to get a measure move up, maybe based on the height of this wedge. We're pretty late in the day, so it'd have to get there pretty quickly. And, you can look at it as there's not enough time to get there, but I think on bar 60, you still have 20 bars, so I still think it's okay. There's a reasonable enough chance you get there. And if 60 closes on its high, I think, that's a really strong buy, hoping to get up to here and just looking for good follow through. And you can see Bulls tried, but 61, bad follow through, big tail on top. 62, inside bar, but you could look at it as leg one, pullback leg two. So it's not as good as it could be. You want 60 and 61 to be strong bull bars, consecutive closing on their highs to buy, and you're just not getting that. And so when you get 63, another bar with a tail, and then a pullback on 64, traders are disappointed. You can see anyone who bought above 63, disappointed 64, gets out on 65. And then bulls give up below 66, and that's what causes 67. Some bears might sell, but I think the important things to keep in mind are bulls are giving up below 66 because they know we're probably getting back to the 59 high because that's where bears sold above, and they should be able to get out at break even because it's probably a trading range. And so bulls giving up below 66 is essentially their way of accepting the trading range. And you get follow through 67, 68. And we stall, around essentially the close of 59. But the important thing to remember is when you see bars like this and it vacuums back to them, you could be forming a trading range, and that could be the bottom of the trading range. 69, it's a big bull bar closing near its high. Maybe you can buy above it. But after 3 straight bear bars, there's a lot of problems with that, and you might have to get back to the 68 high. But I think it's okay to buy above 69, hoping you get big follow through. 70 is barely good enough follow through. I want it to close above the 65 high and break out of something. 70 isn't breaking out of anything. So I think it's okay to stay long for bar 70, but 71 is just flat out disappointing. If you bought above 69, you wanted 70 breaking out of things, and you definitely want 71 breaking out of things. I think 70 is good enough to stay in the trade, but you need 71 to break out of this, and you probably want it closing somewhere maybe up here in a good bull bar. And when you don't get that, a lot of those bulls just flatten their trade at the market, thinking we're at the top of the trading range, and that causes 72. 73, high one, but probably not going much higher, and then we went sideways into the close. Something else to keep in mind, I've been talking about this high for a while, and we touched it today, and you can see that was actually where this bounced essentially. Or no, it was this bounce, yeah. So it was 68.75, and we got to 69 here. So we came within one ticket testing it and found some buyers at least. But it just goes to show, like I say, nothing is random, If you didn't pay attention to that, you can see, sure, it's still a sell climax, and it makes sense that there's a pullback after, a strong pair of bear bars because some traders will take profits. But it's also something to keep in mind that, this is on a different time frame. This is a important resistance point or important support point, as is every single one of these that ever gets touched and ever, finds some sort of reversal there. But I think that was an especially important one, and that's one of the reasons I was looking to get short up here, but it's really hard to sell as 7 is forming. For always in, I thought it was pretty much always in short on the close of 1. And it was pretty much always in short the whole time until maybe, I probably wouldn't say it flipped always in short long above 44, but it definitely did on the close of 45. So if you traded always in today, basically you did really well. You just sold the close of 1 or 2 and then held until 44 and reversed your position. What else? Stop orders, kind of hard. I think 6 is good. Probably sell the breakout below 8 maybe, but definitely sell the breakout below 13 is fine. And then it's sell to close, so you can pretty much sell any bear bar here. And yeah, for limit orders, I wouldn't be buying below anything in this, especially once you get an open gap. I would not be buying below anything, any of this. But you can sell above pretty much any bull bar up until probably, I would stop selling above bull bar somewhere in here. It just gets a little sketchy. Uh, for tomorrow, this is an interesting gap that we have here. Like I said, that's the gap I highlighted at the beginning of the day. So it'll be important to see if bulls are able to reverse that, get a good close. But I think there's enough bear bars here to damage the case of a bull trend. So we basically might get leg 1 and then a 2-legged correction. And maybe we'll form some sort of double top and then get a leg 2 down and continue this trading range we have been in for a while. Yep, that's the day.